Hi everyone and welcome to chapter 16. So in this chapter we are going to discuss about future options and black model. So what are we going to do is we are going to have a discussion about options on futures. So I'm going to explain the concept on Excel sheet and then we'll go through the PowerPoint and come back to the Excel to solve some problems. Okay, so this is the Excel sheet. So what are options on futures? So options or futures gives you, so there are two options, right? Call option and put options. So call option gives you, when you are dealing with options on future contracts, it gives you right to enter into a long position at exercise price. Okay, and put option gives you right to enter into a short position at exercise price. So call gives you right to enter into a long position at exercise price, and put option gives you right to enter into a short position and at exercise price. And in which positions you're taking positions in futures, okay, future contracts. So it's like a double order derivative. So futures is already a derivative on some asset, so maybe stock or commodity, and you're taking an option on that future contract. So it's like a double order derivative. So asset price changes, the future price changes, the option price also changes. So it's like a double order derivative. Now with this information in mind, let's see the PowerPoint. Okay. So futures and options, they are referred to by the maturity month of the underlying options. The option is always most of the times Americans, and usually expires on or few days before the earliest date of the underlying future contract. So what does that mean? So let's take an example. So let's say you have a future contract on buying oil. Okay, and the underlying price is oil. So underlying price oil right now is 46. This future contract is trading on oil. So what will you do? You can buy a call option on this, okay, which allows you to enter into a future contract, that is this future contract, at let's say price of 50, at price of 50. So call option gives you right to enter into this contract, future contract on buying oil, not the original oil price. Okay. Now, if this future contract is more than 50 bucks, so let's say oil price goes up, future price goes up, so and the expiry is very near, so it's 1 week from expiry, and this future contract price is let's say 60 bucks right now. Oil is trading at 60 above, so future price is 60. Okay, so you will exercise your call option, means you get the right to enter into future contract at 50 instead of 60. So you make some money. So that is why it is called as double order derivative. You have a call option on future contract, which itself is a derivative of oil prices. Now why do we do call options on futures instead of call options on oil? The reason is derivative contracts, the future contracts, are much more liquid than underlying commodities. First reason, so liquidity could be one reason. Okay. Second reason could be future contracts, when you enter, they are mostly cash settled. But whenever you deal with commodities, sometimes you have to take and make deliveries. That can be very cumbersome. So that's the reason, instead of taking and making deliveries, you can get into a future contracts which are cash settled and more liquid. Okay. So let's continue. The option is American and usually expires on a few days before the earliest date of the underlying future contract. So mechanism of a call future contract. When a call future is exercised, the holder acquires a long position, that is you go long on the futures, and the cash amount equal to the excess of future price at the most recent transaction. So when you exercise this option, what you would get? You would get $10 of profit plus a long position at 60. Why $10 of profit? Because the exercise price was 50, the future price was 60 when you exercised. So it is already in a profit of 10 bucks that you get, plus you take a long position in oil. Okay. When a put option is exercised, the holder gets short position and the cash position of excess of strike price over the future price. So the cash position or profit or loss is given as follows. So if it is a call option, the cash position or profits will be future price F minus exercise price X. Okay. For a call contract, it is future price minus exercise price. Future price minus exercise price. Of course, per unit. So you have to multiply by number of units you are trading. For a put option, it is X minus S, X minus F, where X is exercise or strike price minus future price. Okay, for call option, it is future price minus exercise price, the amount of money or cash you make. Put option, it is exercise price minus future price. So they have given some example. A July call option contract on gold has a strike price of 1200. It's a call option. It is exercised when the future is 1240 and the most recent settlement is 1238. One contract is 100 ounces. Trader takes a long position in future contracts and get $3,800 in cash. How? Future price minus strike price. So $40 per contract into 100 ounces. Okay, $40 per contract into 100 ounces. Sorry, the most recent settlement. So you have to compare it with settlement price, right? So 1238, right? And 1200, so $3,800 in cash. So 1238 minus 1200 into 100. So let's look at it for put. A September put option contract on a corn has a strike price of 300 per bushel. It is exercised when future price is 280 cents per bushel and the most recent settlement price is 279. One contract is 5,000 bushels. So how to do that? So it is strike price minus exercise price into strike price minus settlement price into 5,000. So it will be strike price 300 minus 279 okay, this into contract size. So 5,000 and it's in cents, so you have to divide this by 10. To get it in dollars. 100, sorry, not 10, 100. So if the future position is closed out, the payoff from call is future price minus exercise price. Payoff from put is exercise price minus future price multiplied by number of units you have. Potential advantages of futures over spot options. Future contracts may be easier to trade than the underlying asset. Exercise of an option does not lead to delivery of an underlying asset. So that's one thing. Liquidity is higher. They are easier to trade. doesn't lead to delivery, they're cash settled. Future options and futures usually trade on the same exchange, so it is easier to take different kind of option positions. Future options may entail lower transaction costs than actually buying options on assets. European future options and spot options are equivalent when future contracts mature at the same time as the option. It is common to regard European spot options as European future options when they are valued in over-the-counter market. So that is important. They are equivalent to European future options, and spot options are similar because exercise always happens in European options at the end. So that's why they are similar. Now you have to change the put call parity function, right, that we have already studied. So put call parity in case of future options. Put call parity in case of future options is call plus discounted price of bond. So exercise price into E minus RT is equal to put plus future price, which is discounted at risk free rate. So this is the put call parity. I'll copy this to the Excel. And sorry about that. So this is put call parity for options, right, based on futures. So difference is, instead of put plus stock, we are doing put plus future price discounted at risk free rate. So let's say they are giving you following things. Exercise price is, let's say, 20 for a stock, right? Future price right now is 16. Okay, put price right now is $6 and risk free rate is 3% and time is 1 year for simplicity. Risk free rate 3%, time 1 year. They are asking you to find call price. So you can rearrange the formula. So it will be, this goes here. So it will be put plus future price discounted at risk free rate minus K e to the power xt, right? So call price will be put price $6 plus future price, that is 16, into exponential risk free rate, so negative sign R is 3%, times T is 1, and this minus K is 20 into exponential risk free rate 3% times 1. So put price will be $2. So if you are given this equation, you can find out call price, put price, future price or strike price by rearranging the terms. Okay. Other relation, if it is an American option, it will be, American options don't have a single value, they have a range. So F0 E minus RT minus K is less than difference between call and put, and which is greater than difference between call and put, and which is less than F0 minus K E minus RT. So this is for American options put call parity. Now based on that, call should be greater than, so lower limit for call will be F0 minus K into e to the power RT, and lower limit for put will be F0 minus K e to the power RT. Okay. Now growth rate of future prices. A future contracts requires no initial investment. In a risk neutral world, the expected return should be 0. The expected growth rate of future price is therefore 0. The future price can therefore be treated as stock paying a dividend yield of R. This is consistent with the result that we have represented so far. So they're doing what? They're trying to derive Black's formula. So Fisher Black was the person who came up with, who modeled to price options on future. So in this case, risk-free rate is given, everything is given. So I'll directly go to the formula. This is the new revised Black's model to find call price and put price of futures. So I'll copy this and we'll do two examples, one for call, one for put, and then we can discuss. When we can go back to the slides. Okay. So I'll write down the steps first for call and for put, and then we'll do problems. So step 1, calculate D1 and D2. Step 2, calculate normal distribution of D1 and normal distribution of D2. Step 3, use call formula. Okay. For put, step 1 is calculate D1, D2. Now calculate N minus D1, N minus D2. Okay, and use put formula. Okay. Now how do you calculate D1? D1 is log normal F0 by K plus sigma square T by 2 divided by sigma root of T, and D2 is D1 minus sigma root of T. So let's do it for one problem for call and one problem for put. So let's say following things are given to you. So F0 is given, F is given, F0, right? Future price is given. So let's say that is $40. Then K is given, exercise price is given. So let's say exercise price is $41. Volatility of stock is given. Volatility, that is sigma, is 30%, right? Time is 1, and risk-free rate is given to be 3%. Risk-free rate is given to be 3%. Now based on that, we are going to calculate price of call option and price of put option. So let's do call first. So I'll copy these steps and then we can solve them. Okay, so first is D1. So D1 will be bracket natural log F0 by K. So F0 is 40, K is 41, plus sigma square, that is 30% squared, right, into T. T is 1 in this case, divide by 2. Okay, and divide this by sigma 30% into square root of T, square root of 1. So this was D1, natural log F0 by K, so 40 by 41 plus 30% squared into 1 by 2, right, T is 1, divided by 30% into square root of 1. So this is D1. D2 will be D1 minus sigma square root of T. So D1 minus 30% into square root of T, that is 1. Okay, so this is D1, 30% into square root of T, sorry, D2. Now we calculate normal distribution, norms distribution of D1 and we calculate norms distribution of D2. So you calculate normal distribution of D1, normal distribution of D2, and you use call formula now. Call formula is exponential risk-free rate 3% times 1, that is time, in brackets. First thing is F0, that is 40 into ND1 minus K, that is 41 into ND2. Okay, so call price should be $4. Call price should be $4. Okay, so let's calculate put price now. So for put, the process for calculating D1 and D2 is same. Now instead of ND1, we have to calculate normal distribution of minus D1, and same way normal distribution of minus D2, not this one, normal distribution of minus D1 and normal distribution of minus D2. Okay, yeah, now we'll use put formula. So put formula is this one, so it will be exponential negative 3% risk-free rate times 1 into K 41 into N minus D2. So this minus F 40 into N minus D1 . So put will be $5. So we can find call and put values using Black's model, which is similar to Black-Scholes-Merton model, but there are few changes. Okay, so they have done an example for that. So consider a 6-month call option on spot gold. 6-month future price is 1240. 6 months risk-free rate is 5%. Strike price is 1200. Then future price is 20%. Value of the option given by Black's model, F0, K, R, T and sigma is known, so you can calculate to $88. Binomial tree with futures is same, right? So first you have to project the future price, calculate the option price based on that and come back. Okay, so setting up a riskless portfolio, this is to prove the binomial tree. So process is the same, except I'll tell you where the difference lies. So the whole thing, like they're just stating what the process is. We have done the binomial tree example, so go back to that and watch it again, but the process is exactly same except the formula for U changes. Okay, so formula for P is, instead of A minus D divided by U minus T, it is 1 minus D divided by U minus T now. So this is the change that you have to do while calculating binomial trees. Now American future prices versus American spot option prices. If future prices are higher than spot prices normally, okay, this is important, so I'll explain it to you. So then there can be two situations. There can be future price is greater than corresponding spot price. Okay, or there can be a situation where future price is less than spot price. We have discussed why it happens. This is called as contango and this is called as backwardation. So in case the future price are higher than spot price, American call will be worth more than American call on spot, and American put will be less than American put on spot. So what does it mean? If this is the case, future price are greater than spot price, that is the markets are in contango, American call on future is greater than American call on spot. Okay, first, and one more equation, American put on futures is less than American put on spot. So American, if markets are in contango, that is future price is greater than spot price, American calls on futures will be greater than American calls on spots, and American American puts on futures will be less than American puts on spot. If a market is in backwardation, when the future prices are lower, the inverse is true. Inverse means if future price is less than spot price, the market is in backwardation, then American call will be less than American calls on future will be less than American calls on spot, and American puts on futures will be greater than American puts on spot. Okay, so future style option, so this is even more interesting. So future style option means these are mostly traded in European exchanges. These are opposite of what we have discussed now. These are futures on option payoffs. These are futures on the earlier we discussed options on futures, right? These American style options are future contracts on option payoffs. So you can go long on a call, right? Or you can go a short on a call, and same way with puts. So these are future contracts that are designed on options. Okay. So future style option is a future contract on option payoff. Some exchanges trade this in preference to regular future options. The future price for a call contract is future ND1 minus K ND2, and future price for a put future style option is KN minus D2 subtracted by future N minus D1. So just to summarize, non-dividend paying stock, this is the put call parity. Indices, this is the put call parity, right? Foreign exchanges, so indices you discount the stock by dividend yield. For foreign exchanges, you discount the stock by risk-free rate in foreign country. For future contracts, you use futures instead of stock. So futures you discount it by risk-free rate. Okay. So we can treat stock indexes, currencies and futures like stock paying a continuous dividend yield Q. For stock, Q is equal to dividend yield on the index. For currencies, Q is risk-free rate, and for future contracts, it is risk-free returns. Okay, so this was chapter 16. So see you in the next chapter.